How many stocks do you know that have increased their revenue by 28x in just the last 5 years? Today we're looking at Fintech Holdings, which does business as TIGR Brokers. The ticker symbol is TIGR. TIGR is the Robinhood for Chinese investors looking for global trading or global investing, global investment exposure. They have a low-cost business structure that has led to rapid growth, and they're quickly evolving to offer additional revenue lines and expand their geographic customer base. As I discussed later in this video, I think their valuation is really interesting, given that you're looking at this hyper-growth business, but it does have some unique, I would argue, Chinese-specific risks that could potentially impair the business model. And we'll go into all of these aspects later in this video. You know, Chinese risks, regulatory risks, and honestly, a lot of people have been burned by past Chinese companies that give you exposure to Chinese market where, you know, it wasn't what you seemed. Maybe you thought you were buying the next Starbucks, like a lot of investors were in Luckin Coffee, and that turned into a donut and a fraud that wiped a lot of people out. There are a lot of stories like that, and so there's this natural hesitancy with looking at companies that give you exposure to the Chinese market. This video goes out to Kenny and all of my Unrivaled Investing Journey subscribers. About that, a quick 10-second plug, if you will, where you're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find you exceptional companies and unrivaled investments. If you enjoy learning about potential multi-baggers, make a point of subscribing. If you're already a subscriber, I appreciate that thumbs up. And if you want to follow my personal journey, as I'm looking for potential multi-baggers each month, go to unrivaledinvesting.com and click on Journey. So let's dive into TIGR and understand what's actually the business model. So what is TIGR Brokers, publicly traded as TIGR? So, you know, you'll see it tossed around that they're the Robinhood for trading apps, Robinhood of trading apps for Chinese investors looking for global exposure. Now, that may be not the perfect comparison, especially as Robinhood may not have the best impression in a lot of investors' minds, especially after the GameStop fiasco. And honestly, their business models, I'd argue, are very different, where here it is, you know, Robinhood has a business where they're selling your order flow to something like Citadel, and you know that's a large portion of their business. Whereas here it's a different mousetrap, where it's more traditionally, you know, commissioned oriented along with traditional financial services. And we'll get into all this in a minute. But the reason why the Robinhood comparison is apt is that Robinhood found their niche with having easy access for retail investors, a mobile-first approach. So that way it's very easy for folks that want to invest or trade for the first time, whether or not it's stock or options, they can easily do so. And that's the angle that they're coming up with for Chinese investors. So investors that are in China that are looking to invest around the world. Now they're broadening that approach over time, but they started off with saying, hey, we're a one-stop destination to trade stocks tailored for global investors, predominantly Chinese investors looking to invest globally. And it's a clean and intuitive trading interface, you know, very similar to what you'd expect from something like what you'd get from Robinhood. I would say a big difference, though, is Robinhood has sort of had a gamification aspect of trading, where it's like, congratulations, you made a trade, and that's not necessarily the angle that you're getting here. So in terms of the trading, you know, in a global marketplace, and you see that theme over and over again, because this isn't just about connecting Chinese investors to local Chinese exchanges. This is about giving Chinese investors access to US stocks, giving access to Hong Kong stocks, UK stocks, Australian stocks, New Zealand, Singapore stocks. So it's about giving Chinese investors global exposure. And I'd argue, and I suspect, that trend of looking for global exposure, Journey subscribers know well about it, as I've commented upon it a few times with a couple of my potential multi-baggers, is that I think global exposure will be something that becomes a bigger and bigger trend, where if you don't have global exposure, you'll be at a disadvantage, because people, I suspect, if inflation starts to pick up, that's one possibility, is if inflation starts picking up in the years ahead, that means inflation is a depreciation of one's local currency. And so you want to figure out or hold other assets that are holding their value relative to your local currency. So people might say, hey, I want to diversify into a broader basket of global currencies, global companies. So having a global first, mobile first approach, and tech first approach, I'd argue, is very critical, and part of the reason that's driven their growth so significantly. Like, you have a lot of Chinese investors that are excited about the US markets. Now, in fairness, the US markets have been one of the leading assets in terms of stock exchanges in the last few years, and so that's part of what's driven that interest. And you can see, the comparison with Robinhood is, I'm sort of saying, look, it's a very low cost business model where trading commissions are less than, less than a fraction of a cent. You're seeing, 0.0039 cents per share traded, at least 99 cents for a single trade. So, effectively a de minimis, fee structure. And you could see it's a similar fee structure. They do it by using effectively these micro percentages. If you were to trade, if outside the US, you were to trade in Hong Kong or something like that. Now, to understand TIGR brokers, it's worthwhile to understand their evolution over time, where it started, I'd argue, as a partnership with Interactive Brokers, which is a major trading platform globally, but predominantly US, where TIGR would onboard local Chinese investors, and Interactive Brokers would then execute, settle, and clear nearly all the orders for TIGR. So effectively, TIGR became the front door to onboard potential customers. Then they would use Interactive Brokers software to sort of execute and make all the magic happen. And so you would think of it as like TIGR started off as a recruiting agent for potential customers, and then Interactive did everything else. But that's just where they were. And then in July 2019, they bought, now this is TIGR bought Marsco Investment Corp, which was a U.S. broker-dealer, where they started positioning themselves to be less reliant on Interactive and to execute and clear many of their U.S. trades themselves, resulting in higher margins and more profitability over time. So this is a key point, which is that previously, and keep in mind, Interactive Brokers made a strategic investment in TIGR, which I talk more about with my exclusive content, but Interactive Brokers effectively partnered with TIGR for bringing in these customers, and then they would pass on their costs to TIGR. So it would be impossible for TIGR to get really high margins unless they ultimately raise their prices significantly. Like, you can't be a low-cost player, but incorporate someone else's cost structure into your business model. So they're slowly, this acquisition happened in July 2019, bringing on their own tech, and their own U.S. licenses with like Marsco to trade, instead of having Interactive do the execution and, let's say, settling of the trades for U.S. companies. Let's do it themselves. And then if you do it themselves, what you were charging previously, instead of remitting it to Interactive Brokers, you can keep it yourself. And that's part of the reason why you're starting to see improved margins and improved profitability for TIGR, which is a really critical point. And as you get more and more scale, and you go from having 90% plus of your trades on Interactive Brokers to, let's say, closer to zero over time, then that profitability should go way up. So, you understand you start off as a low-cost commission brokerage firm, but it evolved significantly over time, from 2014 onwards, where, now 50% of their revenue is this commission model, but they also have other sources like traditional financing for stocks, and that's what you typically see with a lot of these investment brokerages, where they're, if you're short selling or you're borrowing the securities, you're getting, or you're borrowing, stock on margin to buy things on margin. There's some sort of interest income that you're generating from that. And so that all in is about 26% of their revenue. And then the last part is a really interesting aspect of their business, which is where they're getting funds from effectively helping companies IPO. So this is not just a low-cost broker dealer. So that's why, like, comparing it to Robinhood is appropriate only insofar that you think it's a low-cost platform to bring on retail investors in China. That's it. That's I'd argue where the comparison ends, because here it is, you have a lot more other interesting aspects where they one quarter of their business is effectively underwriting new companies that come onto the U.S. exchanges, whether or not it's Chinese ADRs like Li Auto or Xpeng Motors, as well as Hong Kong IPOs, where they recently did New Oriental in the last few months. So, and keep in mind this business, as you think about all these business lines, it's very tied to what are the trends in trading activity. Like, is this a great time to bring companies public? Yeah, this is the yes, any company goes, let's bring them public. 5 SPACs today, that sort of excitement. So that you should understand that aspect from a cyclicality perspective, and also from a trading activity perspective. As more and more people are trading, you're going to generate more and more commissions. So the more people that are borrowing funds because they feel, hey, let's be aggressive, I think these stocks are going to the moon, let's just buy it outright or buy it with debt, and then you're using margin, getting that interest income. So you can see how they're building this really interesting business model that's more than just a low cost broker, or more than just a model where they're selling their order flow to Citadel, where Citadel can try to front run you. It's a more diversified business model, but I'd argue it's still that very cyclical business model that's tied to what is the general market activity in the business. And they also have some other business lines like tied to employee stock option plans, where they help companies manage that. So this is not just the purebred retail, Robinhood model. There's some other really interesting business aspects that's going on here. And what's interesting is they realize that if you have this low cost model, you could roll it out in other countries, as other countries will want to get their exposure. And they've said, hey, we've created a seamless mobile first app that's clearly resonating with Chinese investors. Why can't we do the same in other countries like Australia or Singapore? Because, hey, we've already gotten the licenses to operate there. Why can't we effectively spend some marketing dollars to onboard, let's say, Australian locals or Singapore locals or New Zealand locals? And that's their targets, where they say, today we have licensed subsidiaries in the US, Australia, Singapore, New Zealand. Every day we have investors from these countries choose us to open accounts and trade. Despite the relative scale of our firm, i.e. this is a teeny tiny company, we are an international company that enables global clients to use one account to trade global equities in the US, Hong Kong, Singapore, Australia, and China through the Connect program. So if you're an Australian investor and you want to be able to invest in the exchanges that are available to you for China, you can do that using TIGR brokers. And so this is the appeal, and they're only adding more and more functionality, whether or not it's different funds or futures or options, bonds, currency. So if you believe the world will be increasingly investors will increasingly want to invest in global securities, then I'd argue TIGR is one of the places to consider. And they talk about, look, overseas clients now account for over 20% of our newly funded accounts, and we are confident this number can increase to more than 50% in the next 12 to 24 months, i.e. they can really pump the pedal to get more and more people, let's say from Australia and New Zealand, to become paying customers that are depositing funds with TIGR and start trading and buying securities either on the Australian exchanges or New Zealand, or you're in Australia and now you're buying US stocks or Chinese stocks. And so, as you look at the business, and let me shrink myself a little bit here, as you look at the business, they have just grown so fast in the last few years, from 5 million in revenue in 2016, 58 million in revenue in 2019, and it's continued, 5 million to 58 million, and it's continued in 2020, where you can see, they're posting another 150% growth year to date, or here it is, just quarter over quarter. And interestingly enough, while they were significantly unprofitable for most of these periods. You could see their loss before income tax was fairly significant most of these years. They've recently turned profitable, which one could point to, their initiatives to start bringing on and executing and settling some of their trades themselves versus having to do it through Interactive Brokers. So that's obviously a big deal, and you can see their profit margins have gotten up to about 20% operating margin. So that's a big deal when you start thinking about how do you value this business over time. That starts increasing the odds that, hey, this business is financially sustainable, and that's a big aspect to every company. Do their margins actually translate into profitability over time? And, this story smells great so far, but I also do need to call out that there are, several risks that one does need to consider. Now, obviously, you can go to the regulatory filings, and you should, to read all the different risks, but here are the couple that sort of come out, that call out to me. So first of all, is, as I've already alluded to, it's great to see these numbers, revenue growth straight like that. But you should recognize like what's driving this. And a lot of this is just hype to own US stocks. There's a lot of FOMO, not only for, local investors and or domestic US investors saying, hey, how do I get more exposure to US stocks? But there's fear of missing out from international investors that also want to own US assets. There's a real chance, especially as the US really bungled their COVID efforts, and our deficits have exploded, there's a real chance that the dollar depreciates, let's say, against other foreign currencies, and foreign investors start saying, well, wait a second, why do I actually want to own these stocks? They're already expensive, and the foreign currency starts depreciating. Why would I actually want to own these stocks when I could, let's say, go buy stocks in Australia or Singapore or China? And so, one could argue that is a big risk one should be mindful of, which is that so far, I'd argue it's likely been like one big tide coming in, for U.S. stocks, and that's obviously resulted in very beneficial trading. And you see the activity on trading volumes for U.S. stocks is way up. Could that moderate over time or across a full cycle? Could it be a lot lower, and would that hurt their growth? Another key aspect is that capital controls. Most of their customers are local Chinese customers, where there's a $50,000 limit, effectively capital controls limiting, investors or folks to convert their funds into US dollars up to 50,000 US dollars. And investing isn't actually one of the criteria that you're allowed to convert your $50,000 into. So there's always, I bring this up as a aspect of the Chinese government. They want to manage their renminbi, where they say, hey, this is the rate we want to have relative to, let's say, the US dollar and the euro. So they're very, very mindful of how much currency they actually want going out. And so there's a reason why they have strict capital controls in place that are overseen by several of the regulators in China. So if for any reason, let's say, several Chinese investors were actually converting a large amount of renminbi into US dollars, and they were doing it, and the government were to say, actually, this isn't appropriate, could that lead to problems for TIGR? That's a big question mark, for me. Another aspect is from a competitive standpoint. Now, this one you might be able to look away from, which is that, the reality is they're not unrivaled. There are other players, especially as they're looking to go more and more international. Like, for example, they do have this strategic investment and partnership with Interactive, but they clearly do compete with them in Australia, New Zealand, these other countries. Fudu is a Chinese competitor that's larger and growing faster. And whenever I see that you have a a competitor that's larger and growing faster, it is a little bit of a red flag, because it means they're taking share a little bit faster than you. But either way, when you're tapping into a potentially very large market that can be 10x larger than what you currently are, and keep in mind, they're currently at something like 200,000 accounts that have deposited money. So that could easily be 10x larger. That could be 20x, 30x larger. So their potential to keep growing huge is definitely there. So I'm not saying their growth trajectory is going to stop altogether, but I am calling out some of these risks to be mindful of. So yes, they're probably not unrivaled. You see these other brokerages that are growing very quickly as well. But it's just a risk to be mindful of. Another, I would say a big red flag was that they recently in December 2020 switched their accounting firms from Deloitte to KPMG, and they were only with Deloitte for about 2 years. So, switching an accounting firm, especially when they're used to, you build up a rapport with the accountant, they have all your data. It's a lot easier to build your next, year's financial statements. Like, okay, here's the exact reports we got from this year. Just give us all the same reports updated for the next year, and boom, it'll make it a lot easier for us to run through this process. So that you have the switch in accountants. They also had a material weakness in their historic counting from 2017 to 2019. That, I think, you could probably look the other way. Material weakness is effectively saying you don't have proper financial controls to make sure there isn't something either fraudulent or bad going on internally. I personally, I think you could look the other way because it was largely during that period that it was a private company, and so they didn't have these. A lot of smaller private companies don't put in all the policies in place to make sure, hey, there won't be any material weaknesses, because that does require additional compliance investment that you have to make. And look, they're previously unprofitable, and do you really want to make that trade-off? And there are other regulatory concerns as well. In April 2020, New Zealand, the Financial Authority, issued a public warning that their New Zealand subsidiary, so TIGR's New Zealand subsidiary, had potentially breached some of their anti-money laundering or financial terrorism laws. And so that's a big deal, having to work that off. And these are risks that, look, this isn't all of the risks, and once again, you should go the financials to go through it yourself. But my view is these are some of the ones that it's okay, if you're going to underwrite this investment, you need to think about what are the different ways that this can blow up. And I think the key theme over and over again, whether or not it's capital controls in China to regulatory concerns in New Zealand, is that the regulators, these businesses are highly regulated, and the regulators can shut you down. So not only do you have, regulatory aspects, but you also have sort of the human cycle aspect of where are we in the cycle in terms of trading activity. So something just to be mindful of. That said, from a risk-reward perspective, their valuation does strike me as pretty interesting. I mean, they're growing, I'm penciling out based on what their growth was in the third quarter. I'm penciling out about 140% growth for 2019 to 2020. Their full year 2020 numbers aren't in yet. And then what sort of growth do you get in 2021? I'm doing a ballpark figure of 80 to 100%. Maybe it's lower, maybe it's higher. What are their long-term margins? It's interesting to think that they're at around 20% recently. If you look at other low-cost sort of online brokerages, you'll see that their margins are closer to maturity or closer to 30-40%. So using that sort of as a comp, putting in optimized margins 30, 35, 40%, applying this growth rate, you could see what the earnings multiple would be for this growth rate. And then the question is, what's their appropriate growth in the years ahead? And this is where it gets really tricky when you're thinking about, well, wait a second, what's the multiple? You are talking about a business that only has 200,000 paid accounts that can easily potentially get to 1 million or 2 million over time. But is there a prospect that actually trading activity declines? So you have these multiple variables. One is, yeah, I think you're going to increase the number of accounts, but what is the chance that trading activity starts coming down a lot? So you do have this aspect. So I'm penciling out a fairly wide range of 20% annualized over the following 4 years to 50% annualized, which effectively assumes that they continue this crazy growth in the years ahead, going from either 2x to 5x. And then, based on that, doing this implied, profitability and assumed end multiple of somewhere between 15 and 35 times. The 15 means, hey, investors are a lot less confident. Maybe margins take a hit. Maybe there's more competition and they're not growing the way, investors would expect. Versus, hey, this business continues to operate on all cylinders. They're going super fast, growing super fast. Maybe you slap on a very high multiple. And I argue one of the biggest, drivers behind this multiple is, what do you think their growth rate will be in years 6 through 10? And so that really does drive what you think about this multiple longer term. And this is part of my value proposition to YouTube, my loyal YouTube subscribers, where you can click on the description of this video, click on this hypothetical valuation analysis, and click file download, and you can play around with these assumptions yourself. So, it's an interesting setup. Obviously, could it go a lot higher or lower? Of course, but I like to have a logical framework from which I think about this. And honestly, this isn't a terrible setup where, one considers, several 100% potential upside, and, downside of, let's say, you lose half or a little bit more. And this does take advantage of the fact that the stock has sold off, fairly significantly in just the last few trading days, where it's lost about a third of its value. So it is sort of an interesting risk reward, the challenge once again goes back to these risks. Is even if you are able to pencil that out, can you think about how should you get comfortable that it's not another Luckin Coffee, and that there's some big fraud going on, and that's the reason why Deloitte is leaving them, or that there's some big regulatory risk that they just blow up in the future. Like, yeah, it's great to be able to think about this growth, but how do you underwrite those uncertainties with the investment? And so that's pretty tricky to think about. In summary, as I look at this, I think Tiger Brokers is a bet on global investing, primarily a bet on Chinese investors looking to trade and invest abroad. Only about 200,000 funded accounts now, so the potential to grow by 10x is definitely there. So they could continue to have hypergrowth for years to come. As a tech-first, low-cost platform, they do have the potential to replicate the success that they've had so far beyond China, and they clearly have the aspirations to do so, where they roll this out and start acquiring more and more customers in Australia and Singapore, for example. The fundamental question remains around the integrity of the company, the regulatory concerns in New Zealand, changing their auditor after only 2 years, and I don't have easy answers for these concerns, but I will talk a little bit more about this and how I would think about underwriting these risks and how other aspects to consider in my exclusive video following up on this video. So this exclusive video will just be for Unrivaled Investing Journey subscribers. You can see it in the comments below. I'll pin it to the top of the conversation. And that's just one of the many things that I bring here with Unrivaled Investing. So they should say exclusive content, but so I aim, what is the aspects for unrivaledinvesting.com journey? What's the appeal for users there? Is one is I aim to identify potential multi-baggers each month, and that's a key aspect. Is just every month try to find an idea for you, and you figure out what's right for your journey. Is every month try to find at least one company where I'm like, hey, this has this type of potential where it's several 100% upside, but how should we think about the risk reward? Another aspect is an educational series where at least once a month I post some educational thoughts on either how to value stocks or how to think about potential multi-baggers. I also have stock market commentary where it sort of keeps investors appraised of how I'm thinking about general trends. You can also check out my personal portfolio and see how my personal investment journey is going, where each month I have a full download of my full portfolio, my top holdings, how I think about the risk reward of my top holdings. And you can see the full catalog of content below in the description of this video. You just click on the link and you can see everything, all the exclusive posts, if you want to get your feet wet and figure it out. And at the end of the day, just finding one potential multi-bagger can change your life journey. So if you're interested in following my journey to try to find these potential multi-baggers, go to unrivaledinvesting.com. And at the end of the day, if you enjoyed this video on Tiger Brokers, learning about this hypergrowth company, what might be a global trend of global investing, Chinese investors looking to invest not only in the US, but Australia, New Zealand, and then New Zealand investors looking to invest elsewhere. If this video has struck your interest and you enjoyed learning about this potential multi-bagger, make a point of subscribing and hitting that thumbs up. Thank you so much for watching.